Major support for Carolina Business Review provided by Colonial Life, providing benefits to employees to help them protect their family, their finances, and their futures. High Point University, the premier life skills university, focused on preparing students for the world as it is going to be. And Sonoco, a global manufacturer of consumer and industrial packaging products and provider of packaging services with more than 300 operations in 35 countries.
There is a lot of talk about the cost of goods and services, better known as inflation. And a key part of the Federal Reserve, the U.S. Central Bank's policy, is to manage or head off inflation, or at least manage it. On this program, we welcome back the President and Chief Executive Officer of the Richmond Federal Reserve District, Tom Barkin. In a moment, we will start, and stay with us.
Gratefully acknowledging support by Martin Marietta, a leading provider of natural resource-based building materials, providing the foundation upon which our communities improve and grow. Blue Cross Blue Shield of South Carolina, an independent licensee of the Blue Cross and Blue Shield Association. Visit us at southcarolinablues.com. The Duke Endowment, a private foundation enriching communities in the Carolinas through higher education, healthcare, rural churches, and children's services. On this edition of Carolina Business Review, an executive profile featuring Tom Barkin, President and CEO of the Federal Reserve Bank of Richmond.
Each year or so, we like to include a voice that has some leverage, a voice that also knows what's going on in the region, monetarily, business-wise. We are glad to welcome back the President of the Federal Reserve District of the Federal Reserve, President Tom Barkin. President Barkin, welcome back to the dialogue. Thank you.
No, thank you. It's always fun to be here.
To separate out, sir, a lot of, and I'm just going to call it hyperbole, but certainly emotion around inflation, around jobs, around COVID, around public health concern, around housing. If we try to put those all to the side, sir, what is job one for the U.S. Central Bank from here going forward?
Well, I see job one as normalization. And just for context, this pandemic has been incredible. It's been 2 years. And when the pandemic started, we put in place a set of, I'll call them emergency measures. We took rates down 150 basis points. We've bought multiple trillions of dollars of assets. We've helped solidify markets. And much of that was needed during a time where unemployment spiked to levels that we had never seen in my lifetime. But we're on the back end of this now. Unemployment is now down, most recent report, 3.9%. Inflation, which many of us were worried about 2 years ago, was actually under our target, is now meaningfully over our target. And so in a world where our mandated goals are inflation, unemployment, inflation's high, unemployment is low, it's time for us to get back to normal. So to me, the question is how to get back to normal.
Federal Reserve Chairman Jay Powell, in testimony on renomination to the Fed a couple of weeks ago, as you well know, all but apologized that the Fed was not aggressive enough in addressing inflation and coming out before this. And I'm not going to debate that or ask you about that per se. But when we take a look at inflation as it is now, and inflation's relationship, and I don't want to get too far down in the weeds, sir, but the idea that we've got historic amounts of liquidity and cash looking for a place to go, but yet still a lot of inflation, how do you balance those two ends of the barbell? And is that, it's got to be a delicate balance, is it, for the Fed?
Well, think short term and think medium term. Inflation. There's no doubt in my mind that inflation today is being significantly driven by a set of factors having to do with this pandemic. On the demand side, we've had stimulus at extraordinary levels. We've had repressed spending during the shutdown that's come back into the economy. We've had a big rotation from services into goods. On the supply side, we've had all the outages that you know, and the listeners have heard about, boats lined up outside of ports. And then we've had these constraints on labor supply, some of which are also related to COVID. So we've had price pressures at significant levels across the economy. driven in big part by what's happened in and out of the pandemic. You notice I didn't say cash and liquidity levels. Okay. Now, in the medium term, cash and liquidity, they do matter a lot. Monetary aggregates do matter a lot in terms of what happens for inflation. So in the medium term, the challenge is, how do you get that under control? How do you get rates in the right place? How do you get money supply in the right? Those are the kinds of issues you've got in the medium term. But I want to make sure we separate those, because in the near term, I don't think that's what's been driving inflation. I think it has been the dynamics that you and I all know about in terms of supply and demand.
Let's unpack the supply just for a minute, President Barkin. The idea that it's been, I'm going to say, weaponized in the press because of the high emotion around getting goods on shelves, getting services, as you said, in the ports, having a lot of boats backed up. An economist said that we may be thinking about this wrong. It certainly is a supply chain issue, but it's more of a demand crisis that started in March of 2020. How do you characterize that?
Well, both sides are right. There's demand in this and there's supply in it. I think if you go back to April of 2020, the economy was shut down. If you ran a manufacturing operation, you were worried about having too much capacity, not too little capacity. We had state, local governments actually shutting down some manufacturers. And so if you look at the economy in the summer of 2020, it was actually deflationary, not inflationary. We had unbelievably short demand, and the demand was actually less than the supply that was being created. Now the economy reopened, and in particular in the spring of last year, spring of 2021, with vaccines hitting, it reopened in force. And when the economy reopened in force, what happened is you had an extreme increase in demand. That demand rotated, as I said earlier, from services to goods. And manufacturers, many of whom had constrained capacity during the shutdown, just weren't able to catch up. And I don't blame manufacturers for that. If I were a production planner and it was January of 2021, I didn't know if vaccines would roll out. I didn't know if they'd be effective. Yeah. I didn't know there'd be another $2 trillion of stimulus in March. There was a lot I didn't know and couldn't anticipate for what was happening. But what's happened, of course, is that demand has escalated, supply hasn't caught up. Then on the supply side, it's not just the production planning part, because most people, myself included, thought labor markets would come back a lot faster than they actually have. And you still have almost 4 million fewer people working than you did in February of 2020. And those people are not working in part because they've retired, in part because they're taking care of kids or grandkids, in part because they're worried about their health and COVID, perhaps in part because they've got money in their pockets and aren't yet ready to come back to work. Perhaps they've had a life change. And so, that amount of the supply side, that part of the supply side, people just weren't ready for either. So yes, demand's part of it. Yes, supply is part of it. And again, we just have a rebalancing we're going to have to go through. And I think that's going to be the 2022 story.
You referred to it here just a second ago around this, and I'll call it the Great Resignation because it's been coined that term. Is the Great Resignation being miscast as just, and I don't want to oversimplify it or diminish some of the angst around it, but is the Great Resignation really a change in how labor and workers interact and become part of what this economy is?
Well, I think of the workforce in 3 different segments. Maybe this helps. I start with skilled trades. And of course, that'd be plumbers and carpenters and welders, but it would also be truck drivers, and it would also be nurses. And that's a group that was short before we started. And COVID has only made them shorter. Construction has boomed, manufacturing has boomed. Obviously, you've got the needs in the healthcare system and truck drivers. And we just don't have the manufacturing, if I want to put it that way, in place to catch up with what we need in terms of demand. That hasn't been a change. We don't have truck drivers leaving the economy, I don't think. This is about, we just haven't manufactured enough of people in the skilled trades. Then you've got a second segment, which I'll call lower incomes personal service workers. Millions and millions and millions of them were laid off in April of 2020. Some went on to other jobs, but many of them, having now been called back to work, are not coming back to work. And I do think that segment has changed its view on what it means to work in that sector. Maybe it's health concerns. Maybe it's not wanting to wear masks at work. Maybe it's having found their way into other careers. But that's the place where the economy is short. That's where the 4 million people are. And you could characterize it as a life change, but it's not a life change. It's, a job that looked stable before is no longer stable. A job that looked healthy before may not look healthy. And there are other alternatives out there. The third segment is the professional class. And unfortunately, when most of us read about the Great Resignation, we're thinking about ourselves. That segment's tight, but it's not so tight that it's at historic levels of tightness. You do see some resignations there, but you're not seeing the quit rates or even the wage escalation in that segment the way you are in the other two, with the exception of some places like, artificial intelligence and cyber and cloud transition. And that's the place you have to worry about. But I don't think yet we're seeing that sort of massive life change.
President Barkin, we're going to jump around here a little bit, but I want to make sure that we do, while we got you, check all these boxes. And before we go any further, if you're watching this program, this is actually being recorded here in mid-January, January 14th to be exact. And you are watching it now, at least on February 4th, if not later. So it's important to know that these comments in respect to that. Let me come back to the cash just for a second, President Barkin. The idea of so much cash, so much liquidity, and I don't mean just federal relief, but low interest rates, of course, as you well know. How much distortive effect does that have on this current economy? And how do you discount that effect of all of that cash waiting for a place to be placed?
Well, I do think there's a lot of, I'll call it artificiality in the economy. That includes fiscal stimulus, which has gone into lots of different places and has both created demand and inhibited supply. That would include COVID, which has both rotated demand and affected supply. And of course, low interest rates, have an effect. Now, there are interest sensitive sectors. Housing would be a good example, automotive, where lower interest rates do, motivate people to buy. It makes it cheaper to buy something. So I think that's very much real. Now, one thing that's interesting is that lending isn't really elevated. So the other way you would think low interest rates would lead to a lot more borrowing. But maybe it's COVID, maybe it's the stimulus programs. Consumer credit, with the exception of mortgages, hasn't really elevated. In fact, people have paid down their credit card bills. Commercial credit, fine. Government debt is up. I'm not sure it's that, but I don't think you've seen the full impact because of these other, I'll call it more physical factors, both the fiscal stimulus and the COVID impact.
What of interest rates? How much of interest rates driven real estate prices, both commercial but specifically residential? Half, 60%, 20%? How much do you think has been the motivation on what's going on in a spectacular real estate industry?
Well, I think there's no doubt if mortgages are less expensive, if the cost of a monthly payment's less, then you can buy a little bit more. But it sure seems to me that what's going on is an entire society was stuck 24/7 in their house. And there's just no way to understand the flaws of your house any better than living in it 24 hours a day. And so people in apartment situations decided they needed to buy a house. People in New York decided they needed a second house. People moved from the city to the suburbs. At the same time, a generation of millennials that had decided not to get into houses coming out of 2008 got to the point, started having kids, and decided they really needed a house. And even the supply of houses was short because, I wasn't going to move my mother from her house into a multifamily situation during a time of COVID. So again, the physical demand supply factors, I can't say the cost of money doesn't matter, but I think the biggest driver of demand has been this need to get a better house.
Are there any conversations that go on in a formal FOMC meetings or some of the informal conversations that you have around the district that when the economy does turn and the economic cycle does again rear its head on the slow side, that we will be faced with large homes and maybe even with the low cost of funds here, President Barkin, that we could get into a situation where people can't afford it? Is that a problem?
We'll see, how all this plays out. I'll say the other thing I didn't mention is for 10 years post the crisis, we also didn't have that much construction of homes. Mm-hmm. And so I do think it's a market that, as we all know, was massively bushwhacked in 2008, 2009, and it's just taken a long time to come back. And so 10 years of underbuying, 10 years of underbuilding, we finally caught up. And so I don't have the sense that the supply that's being put on the market today is going to overwhelm the demand that's still out there that's unsatisfied. Of course, there's some point in the future where those lines could cross and you would see it. But, on my list of markets of concern, the housing market's not, at the top of it. I'll also add leverage ratios in that market are nowhere near where they were 15 years ago. And so, people are not as levered up in their houses. And of course, that's your risk. It's not just valuation dropping, right? It's valuation dropping at a time where you've got, more leverage than you can afford. And at least so far, what I see seems okay.
Wait, shifting from the residential side to the commercial side, you've got commercial developers, owners of properties saying that they haven't seen cap rates here 5.5, 6 max, but around the 5 is where cap rates are in markets like Charlotte, Raleigh, Charleston, Greenville, South Carolina, of course, Asheville. All of these markets are high growth markets. Is that a permanent change, sir? Do you expect those cap rates to go back up, or is just this a new high water mark that will have to assimilate what part of commercial real estate is now going to have to be that way?
Oh, I mean, commercial real estate, I think, is a story that's still unfolding. Most people would have thought that in the context of work from home, that especially office and even, retail would just, fall off the table. And that hasn't yet happened in the way that you might have guessed. Now, part of it is that there are segments. Industrial is still white hot. Multifamily has come back strong, and rents, particularly in our region, quite strong, as opposed to places like, New York or DC. Mm-hmm. But I think downtown office space in particular, the story is still going to be told. The leases are very long. There's still uncertainty about how people are going to work. And I think in that context, you've not seen, the weakness in that market that you might have expected. Yeah, vacancies are creeping up, and we'll just see where it happens. And I expected to know a lot more, and this may be a bigger story. I expected to know a lot more in the first half of this year, but I think Omicron has messed things up just one more time. And so it'll just take a while to see what normality looks like on the other side of it.
Yeah, is there any surprise with the Omicron variant? Is how it's affected either good or bad for you? Have you looked at it to say, well, it's more acute maybe in some ways, but you feel like there's a lot of, and I don't want to put words in your mouth, but a lot of fatigue around public health?
Well, the human side of this is just severe exhaustion and weariness, because all of us sort of hoped that this thing was going to be over when the vaccines rolled out. And then the Delta thing came, but boy, maybe we've got that behind us. And so the notion that there's one more virus and perhaps even, others behind it, mm-hmm. I think, we're all just exhausted. I am on viruses in general. The second thing, I think there's just a shock value. If you look at the 7-day average caseloads, we thought the winter of 2021 was bad enough, but the numbers have been truly astounding. 3, 4, 5 times the numbers we saw at the peak last January. On the reassuring side, obviously, it's not leading to the same kind of hospitalization and death situation. So there is a potential that this thing starts to move toward endemic as opposed to pandemic. And I will say that's what I see on the demand side. Business travel, of course, is being curtailed. Conference catering is being curtailed, but things that are very specific to in-person work, I think you definitely see the impact there. But I don't think you see it in the rest of the demand situation, at least the numbers that I'm tracking. Now, where you do see it, and this is where I mean in terms of it'll delay getting back to normal, is on the supply side. And I think it is probably fair to say that unless we get a variant that puts a lot of us back in the hospital, COVID has become a supply side issue. It's no longer a demand side issue. We're not shutting economies down, with the exception of those sectors I'm talking about. but it is hitting the supply side. We had all the demand we wanted over Christmas for airline travel. We just didn't have enough airline crews. Right, that's a good example.
Right.
I'm definitely see that in terms of shortages. I was talking to a meat processor yesterday who's having trouble getting staffing. I mean, so it's going to hit the supply side, and that means it's going to delay the workforce's return to full employment, and it's going to, unfortunately, probably create pressure on prices.
Any idea when business travel will approach a rebound?
Boy, I mean, you have to make an assumption on variance first. I will note that if you go back even 6 months ago, when Delta started to surge, people pretty quickly canceled their October plans. What I've noticed at this point is, and this will be aired February 4th, so we'll see if it's any different by the time it's aired, people are canceling 2 weeks out, but they're not canceling 6 weeks out. So I think even the business cancellation window, people want to get to the other side of it and want to get exposed. And I'm hopeful and expect that, in the spring, especially the ability to do stuff outside, you're going to see this behind us. But I think the window's shortened, but you're still seeing it hit the business behaviors.
One of the bright spots around policy, at least spending policy, is the infrastructure bill. It's something short of $2 trillion. But it's large. When do we start to see the benefit of those dollars? Where does it start to be deployed, and how do you kind of look at that?
Well, it's about $1 trillion. It's
right. Better
got a real focus on broadband that is, I think, going to be deployed relatively quickly. And most of the communities I talk to are getting organized as quickly as they can to get that deployed in the right place. There's a bunch of other stuff that's roads and bridges and ports and the like, and that you've got to take time to build that. These things are not as shovel ready as you might have hoped. The thing I worry the most about, though, as I suggested earlier, is infrastructure workers. Do we have enough people to do the work, and what kind of pressure are we going to have on what's already a white hot infrastructure market? And so it doesn't stress me too much if the infrastructure money comes out 18 to 24 months from now. Because if you gave me another road to build, I don't know where you'd find the people to build it today. And so I think, again, we've got to get the economy back. I'm really hopeful. And a negative trend that we've seen is enrollment in these community college degree programs. Enrollment in community colleges is down this year. It was down last year. Probably part of that is that wages are up for entry-level jobs. And so people faced with a choice between getting a credential and taking a job or actually finding the jobs more attractive. But regardless, those are the places that produce a lot of these infrastructure workers. And we've just got to find a way to get more people in and through these programs and licensed into these jobs, because I think there will be the demand for that infrastructure. But we're going to have a supply shortage.
Well, so then where do the workers come from? Quintessentially, where do you see them coming from?
Well, we have an economy where even February 2020, 63% of people were working, 80%, little less, of prime age workers were working. We have workers on the sidelines throughout the economy. In the smaller towns in our district, lots of them have almost half the population not in the workforce. And so bringing people into the workforce, which is a combination of attractive jobs, getting people the training, thinking hard about search, thinking hard about breaking down some of the barriers that exist today, whether they be licensing issues or drug tests or other background check. Getting folks in the economy, I think, is a real imperative. I gave a speech on that in Greenville a couple of months ago. I think that's actually a really big deal for us. That's what we've got to work on if we're going to get enough people into these jobs so that we can get the work done.
But we can't blame federal relief money for lack of unemployment participation anymore, can we? We're pretty well past that. Do you feel that?
Well, I certainly would have been among the people last August who expected when the enhanced unemployment insurance expired that you see a surge of people into the workplace. We just haven't seen that. Now, why that is, again, I believe that part of it is COVID and health concerns still. I believe part of it is care concerns, whether that be elder care or child care, or frankly, grandkids taking care of grandparents taking care of their grandkids. I hear a lot of that. uncertainty of school. So I think that's part of it. I do think there's a piece to it, which is even the less fortunate among us still have more money in their pocket today than they did 2 years ago. JP Morgan says liquid savings are up 70%, even for that segment. Again, that's $1,000, not a huge amount of money. And so some of it will have to work down. Now, some of that probably came from transfer payments, but some of that also came because nobody spent as much during COVID as they did before. And so people saved money in ways they hadn't before.
Mm-hmm. If you've been watching this dialogue, it is important to remember and to note, program note, it is being taped here on January 14th, but actually probably you're seeing it now for the first time on February 4th. But again, our thanks to President Barkin, Richmond Federal Reserve President, who is now starting, I think, your 5th year. Is that
That's
accurate?
Right. Goes fast.
Well, congratulations, sir. We're glad to have you on the job. And again, nice to see you and best of luck going forward. Stay healthy.
Thanks, Chris. You too.
Thank you for joining us. Until next week, I'm Chris William. If you have any questions or comments, like to watch a rebroadcast, go to carolinabusinessreview.org. Until next week, happy weekend. Stay warm.
Major funding for Carolina Business Review provided by High Point University, Martin Marietta, Colonial Life, the Duke Endowment, Sunoco, Blue Cross Blue Shield of South Carolina, and by viewers like you. Thank you.